Microeconomics for Investors. Chapter 5, Competitive Advantage. Section 1, Economic Moats. An economic moat is a company's ability to keep competitors from easily taking away its profits, customers, or market position. The image comes from a castle protected by water. The business sits inside, while rivals face real obstacles trying to attack it. For investors, this matters because a good business is not just one that earns money today, but one that can keep earning strong returns after others notice the opportunity. Many companies look successful for a year or two, especially in a strong economy or during a product boom. A true moat is different because it helps profits persist over time, even when competition becomes more intense. That durability is what turns a strong product or service into a potentially valuable long-term investment. Moats matter to investors because they show up directly in business performance. A company with a real advantage often keeps customers longer, which makes revenue more stable and lowers the cost of replacing lost demand. It may also have pricing power, meaning it can raise prices without losing too much volume. Those traits often lead to returns on capital above the industry average, which is one of the clearest signs that competition has not fully erased the business's edge. Just as important, a moat can give management the chance to reinvest profits at attractive rates instead of constantly defending a fragile position. Over time, that combination of protection and reinvestment is what supports compounding. One of the biggest mistakes in moat analysis is confusing a structural advantage with a temporary tailwind. A structural advantage is built into the economics of the business, so it tends to survive across booms, recessions, and competitive cycles. A temporary tailwind might come from a shortage, a favorable commodity price, a hot product, or a cyclical rebound. Those conditions can make profits look excellent for a while, but they often fade once supply catches up or competitors respond. That is why investors should ask a simple question. If conditions normalize, what still protects this company? If the answer is very little, then you are probably looking at momentum rather than a moat. Most durable competitive advantages fall into a small number of recurring categories, which makes moat analysis more practical than it first appears. One source is switching costs, where customers face inconvenience, risk, or expense if they leave. Another is network effects, where the product becomes more valuable as more users join. Cost advantages matter when a firm can produce or deliver at lower cost than rivals, while intangible assets include things like brands, patents, licenses, or proprietary know-how. Efficient scale applies when a market is only large enough to support a few players, so new entry is unattractive. Many of the strongest businesses combine several of these rather than relying on just one. Each moat source protects a business through a different mechanism. Switching costs work by making the customer hesitate to leave, because changing vendors might disrupt workflows, require retraining, or create operational risk. Network effects work differently. Every added user improves the experience for existing users, which makes the network harder to challenge. Cost advantages allow a firm to defend margins or cut prices in ways that smaller rivals cannot easily match. Intangible assets and efficient scale often deter entry altogether, either because legal protection, trust, or market structure blocks a newcomer from earning acceptable returns. In every case, the core question is the same. Can competitors realistically copy this, or is the barrier genuinely hard to overcome? To analyze a moat well, start with the competitive pressure rather than with the company's branding or reputation. Ask what could actually hurt the business. Lower prices, substitute products, regulation, new entrants, or changing customer behavior. Then look for structural barriers that would make those threats less dangerous. After that, check the financial evidence such as margins, retention, market share, and returns on capital to see whether the economics support the story. It is also important to separate durability from momentum because a rising business is not always a protected one. Finally, watch for signs of erosion, since even strong moats can weaken long before the market fully notices. Moats are not all equal, so investors should judge both width and durability. A wide moat means the current advantage is powerful and hard for rivals to attack. A narrow moat means there is some real protection, but it may be limited in scope or easier to chip away at. And eroding moat means the company may still look strong in backward-looking numbers, while the underlying defense is already weakening. This distinction matters because stronger, longer-lasting moats can make future cash flows more predictable and reduce the chance of nasty competitive surprises. In practice, your investment judgment improves when you ask both how strong the moat is today and how likely it is to still matter years from now. Adobe is a useful moat example because its advantage is not just that people like the products. Creative professionals, agencies, and in-house teams often build entire workflows around Adobe software, file formats, and shared standards, which creates meaningful switching costs. Collaboration also matters, because using the same tools makes it easier to work with clients, editors, designers, and production partners. On top of that, Adobe keeps investing in the product, which raises the bar for competitors that would need to match both the software and the ecosystem around it. The shift to a subscription cloud model strengthened these advantages by deepening customer relationships and supporting continuous improvement. Financially, the company's high returns on capital suggest that the moat has been more than a marketing story. Moat analysis often goes wrong when investors rely on surface signals instead of structural economics. A strong brand by itself is not always a moat if customers still switch easily when prices change. Large market share is also not enough, because a company can be big in a weak or temporary position. Technology can quietly undermine old advantages, which is why businesses that once looked untouchable can deteriorate faster than expected. It is also important to remember that moats are not free. A company may have to spend heavily on product updates, advertising, or regulation to defend its position. The real test is not whether a business looks impressive, but whether it earns excess returns after the cost of defending itself. The best way to get better at moat analysis is to practice on a real company. You do not need a long report. A short written argument can be enough if it clearly links business strategy to financial outcomes. Start by listing the company's likely moat sources, then explain why each one is structural rather than temporary. After that, judge whether the moat looks wide, narrow, or eroding, and support that view with evidence from returns on capital, margins, retention, or market share. Comparing your reasoning with the company's historical results helps you see whether the story and the numbers line up. That habit turns the idea of a moat from a slogan into an investment tool. Section 2. Network Effects. A network effect exists only when new users make the product more valuable for users who are already there. That definition is stricter than many people assume. If a business simply gets larger, cheaper, or more heavily marketed, that may drive growth, but it does not automatically create a network effect. The key is a positive feedback loop. More users improve the experience, the better experience attracts more users, and the network itself becomes an advantage. Messaging apps, marketplaces, and payment systems are common examples because participation changes the usefulness of the product. For investors, this matters because features can often be copied. But an active, valuable network is much harder to recreate. It is important to separate network effects from ordinary growth. A company can grow quickly because of strong marketing, low prices, referrals, or temporary excitement, even if the product does not improve as more users arrive. Virality is not the same thing as a moat, and neither is popularity. The test is simple. If 1,000 new users join, does the product become better for the people already using it? If the answer is no, then you may be looking at scale or momentum rather than a true network effect. This distinction matters because businesses without real user-added value are often easier for competitors to copy or undercut. Network effects usually appear in three main forms. Direct network effects happen when users on the same side add value to one another, as in a messaging app where more people means more possible connections. Indirect network effects happen when a growing user base attracts complementary products, such as developers creating more apps for an operating system. Two-sided network effects appear in marketplaces where growth on one side, like buyers, increases value for the other side, like sellers. Each type strengthens value in a different way. So recognizing the pattern helps you judge whether the network is likely to deepen over time. For investors, the mechanism matters because some forms are easier to build and defend than others. Familiar examples make these categories easier to recognize. A messaging app shows a direct network effect because each additional user increases the number of people everyone else can reach. An operating system shows an indirect effect because more users attract more developers, and more software makes the platform better for users. A marketplace shows a two-sided effect because more sellers improve selection for buyers, and more buyers improve demand for sellers. In all three cases, the important point is not just growth in user count. The important point is that the user experience improves as participation increases. That improvement is what can turn growth into a moat. Most network businesses do not start with a moat, because small networks often feel empty or unreliable. If there are too few users, too few listings, or too few participants on one side of the market, early users may not get enough value to stay. That is why critical mass matters. A platform usually needs minimum viable scale before growth becomes self-reinforcing. Many successful platforms solve this by focusing on one city, one niche, or one user segment first, where they can build enough density to make the network genuinely useful. Once that local density is achieved, expansion becomes much easier. After critical mass is reached, the moat can begin to strengthen in several ways at once. More activity improves matching, recommendations, and overall usefulness, which makes the experience better for users. Better experiences tend to reduce churn, so more participants stay in the network instead of drifting away. Over time, users may also build assets that are hard to move, such as ratings, transaction history, contact networks, saved preferences, or reputation. At that point, network effects and switching costs begin to reinforce one another. The result is a deeper advantage than simple user growth alone would suggest. Copycats often struggle because they can replicate software features more easily than they can replicate active participation. A rival may build a very similar interface, offer lower prices, or copy the core product design almost exactly. But an established network has something more valuable: density, trust, and liquidity. Buyers know there will be enough sellers know there will be enough demand, and both sides often trust the platform because of reviews, history, and past transactions. A new entrant has to build all of that quickly, which is much harder than shipping new code. That is why network businesses can look vulnerable on the surface while remaining difficult to dislodge in practice. A freelance marketplace is a simple way to see this dynamic. If a platform has 50 designers and 10 clients, the market feels thin, clients may not find the right fit quickly, and designers may not see enough worthwhile projects. If the same platform has 500 designers and 200 clients, matching improves, choice improves, and response times improve. More clients attract more designers because there is more work available, and more designers attract more clients because the platform becomes more useful. The value is not coming from the website alone. It is coming from the depth and activity of the market inside it. That is the essence of a two-sided network effect. The strongest network moats usually add trust and switching costs on top of participation growth. Ratings and reviews help users judge quality, which makes the platform safer and more reliable. History improves matching because the system learns which users, products, or service providers are good fits. Reputation can raise switching costs, especially if a seller, creator, or professional has spent years building status on one platform. Quality control also matters because a network that becomes full of spam, fraud, or low-quality activity may grow in size while shrinking in value. A durable network moat is therefore more than a big user base. It is a user base supported by trust, data, and healthy interaction. Network effects can weaken, and they often weaken in ways that are easy to miss at first. If growth leads to spam, fraud, congestion, or poor matching, the product may become less valuable even while usage numbers look impressive. Another risk is multi-homing, where users can easily participate on several rival platforms at once. If buyers and sellers, drivers and riders, or creators and audiences can switch back and forth with little friction, the network may be less defensible than it appears. That is why scale alone is not enough. A real network advantage has to be maintained through quality, relevance, and enough friction to keep the ecosystem from becoming interchangeable. When evaluating a possible network moat, a few questions go a long way. First, do new users actually help existing users, or is the business simply growing in size? Second, has the platform reached critical mass where value is strong enough to sustain itself? Third, can users easily switch or use multiple platforms at once, which would weaken the moat? And fourth, Is growth preserving trust and relevance, or is quality slipping as the network expands? If you can answer those questions clearly, you are much less likely to confuse hype with durability. That discipline is especially useful in fast-growing digital businesses, where network effect claims are often overstated. Section 3. Scale advantages. A scale advantage exists when a company's cost per unit falls as output rises. For investors, this matters only when the lower cost becomes a durable edge over smaller competitors, not just a temporary benefit from being busy. If a scaled firm can produce more cheaply, it has options. It can lower prices, defend margins, or reinvest the savings into growth. That flexibility often matters more than the cost gap itself. In competitive industries, a lower cost producer can survive price pressure that would hurt weaker rivals. So the real question is not whether a company is large, but whether greater volume actually improves its economics. One of the most common sources of scale advantage is fixed cost dilution. Some costs do not rise very much as output increases, so each unit carries a smaller share when the company sells more volume. A factory, headquarters staff, software platform, advertising base, or R&D effort can all work this way. If those costs are spread across many units instead of just a few, the cost per unit falls. That can create a meaningful edge if rivals must carry similar fixed costs over a smaller sales base. In practice, this is one reason market leaders can sometimes earn stronger margins even when they sell very similar products. A simple numerical example makes fixed cost dilution easy to see. Suppose a factory costs $10 million to build and operate at a basic level. If the company produces 1 million units, that fixed cost adds $10 to each unit. If it produces 5 million units instead, the fixed cost falls to $2 per unit. Nothing magical happened to the factory itself. The same base cost was simply spread across more output. That is the heart of operating leverage, and it is one of the clearest ways scale can improve unit economics. Scale can also reduce variable costs, not just fixed costs. Larger buyers often get better input prices because suppliers value large, predictable orders. They may also receive better payment terms, which can improve working capital and reduce financing pressure. During shortages, large customers are sometimes served first, and in some cases they can secure dedicated capacity from suppliers. Those advantages lower the cost of each unit and can make the business more resilient when conditions get difficult. For investors, this means scale may improve economics through purchasing power as well as through simple cost spreading. Distribution often becomes more efficient as volume rises. A business with higher throughput can fill trucks, containers, and warehouses more effectively, which lowers shipping and handling costs per item. Greater volume can also justify regional warehouses, route optimization systems, and automation that smaller firms cannot support economically. These improvements are easy to underestimate because they may look operational rather than strategic. But over time, logistics efficiency can widen the cost gap between a scaled incumbent and a smaller rival. In industries where products are low margin or price sensitive, that difference can be a major competitive weapon. Higher volume also makes specialized investment worthwhile. Some cost-saving assets only pay off if they are used heavily enough, such as automated assembly lines, proprietary software tools, in-house testing facilities, or dedicated engineering teams. A low-volume competitor may know these investments would help, but still be unable to justify the cost. A high-volume firm, by contrast, can keep those assets busy and spread their cost across enough output to make the investment attractive. That often leads to lower unit cost, better quality, and faster production at the same time. When that happens, scale is not just bigger size, it becomes a self-reinforcing operational advantage. Scale becomes a true moat when it creates a structural cost gap that smaller competitors cannot easily close. High fixed costs are one reason, but supplier advantages, efficient distribution, and customer price sensitivity all strengthen the effect. If the market leader can produce at lower cost and customers care strongly about price, smaller rivals may struggle to gain share without accepting weak margins. In some markets, large efficient scale also discourages entry because a new player would need major volume before it could compete effectively. That creates a feedback loop where scale lowers cost, lower cost supports better pricing, and better pricing attracts more customers. At that point, Scale is protecting the business rather than simply describing it. It is important not to confuse being big with being scalable. A company can have high revenue and still see costs rise almost as fast as sales, leaving unit economics unchanged. In some cases, growth even creates coordination problems, waste, or overhead that offset the benefits of size. A scalable business is different because additional volume actually improves the economics, fixed costs spread more widely, processes standardize, and the cost per unit declines. So, when studying a business, the key question is not how large it is today, but whether added volume makes each unit more profitable or more efficient. Scale has limits, and investors should not assume bigger always means better. At first, unit costs may fall as the firm spreads fixed costs and improves efficiency, but after a certain point, those benefits often flatten out. Beyond the most efficient size, extra complexity can create bureaucracy, slower decisions, and weaker accountability. If too many layers build up, unit costs may even start rising again. This is why some large organizations become less efficient over time despite having more resources. A real scale analysis should include both economies of scale and the risk of diseconomies. A practical way to evaluate scale is to trace how costs behave as revenue grows. Start by separating fixed costs from variable costs, because the sources of advantage are different. Then look at whether growth has actually lowered unit costs over time, rather than just increasing total profit dollars. After that, check for purchasing power, logistics efficiency, and other operational benefits that might strengthen the cost position. Finally, watch for overscaling risks such as organizational sprawl or rising complexity. The goal is to decide whether scale is creating a durable cost advantage or just making the business larger. A simple rival comparison shows how powerful a cost gap can be. If one producer can make a phone for $200 while another needs $250, the lower cost firm has a $50 advantage on every unit. That is roughly a 20% lower cost base, which is a major difference in a competitive market. The cheaper producer can choose to offer lower prices, keep higher margins, spend more on marketing, or invest more in product development. Importantly, the advantage may come from more than one source at once, such as better fixed cost absorption and lower component costs from bulk buying. When a cost gap is both meaningful and durable, scale can become one of the strongest moats in investing. A good exercise is to test scale using a real annual report. Pull out revenue, cost of goods sold and selling, general and administrative expense, then express those costs per dollar of sales. That helps you see which costs might shrink as volume grows and which ones are likely to rise with each sale. You can then imagine revenue doubling without proportionate new assets, and ask how much the economics would improve. Just as important, identify at least one possible diseconomy, such as overhead creep, service issues, or coordination problems. That kind of exercise trains you to see scale as a business model question rather than just a size statistic. Section 4. Intellectual property. Intellectual property, or IP, is legal protection for creations of the mind. It includes inventions, brands, software, and certain forms of know-how, and it matters to investors because it can make imitation harder. If competitors cannot freely copy an important product, process, or identity, the company may have more time to earn attractive returns. That extra time is especially valuable when the business made large upfront investments in research, development, or brand building. In effect, IP can act like a legal moat around part of the business. But as we will see, owning IP is only the beginning. What matters is whether the protection is economically meaningful in practice. IP can create substantial economic value when one protected asset can be reused many times at low incremental cost. A drug formula, software platform, or powerful brand may require heavy upfront investment, but once created, it can often be sold again and again without building a new factory for each customer. That gives protected IP a very different scaling profile from many physical businesses. It can also limit closed substitutes, support premium pricing, and lift margins above industry averages. For investors, this combination is attractive because it can produce strong returns on invested capital. The most valuable IP is often not just legally protected, but also commercially scalable. There are 4 main forms of intellectual property, and each works differently. Patents protect new and useful inventions, often for a limited term, and are common in pharmaceuticals, semiconductors, and industrial technology. Trademarks protect brand identifiers such as names, logos, and slogans, and can last a very long time if they are defended. Copyrights protect original creative expression, including software code, books, music, and media, but they do not protect general ideas. Trade secrets protect valuable confidential information, such as formulas, methods, or algorithms, for as long as the secrecy can be maintained. For investors, it is important to know not just what form of IP a company owns, but how long it may matter and what could weaken it. Each form of IP supports a moat through a different mechanism. Patents can block direct copying for a period of time, which is especially powerful when rivals cannot easily design around the claim. Trademarks create trust and recognition, helping support repeat demand and, in some cases, premium pricing. Copyrights control the use of creative works and code, which matters in media and software businesses where duplication would otherwise be easy. Trade secrets protect formulas, processes, and algorithms that may never be publicly disclosed. The strongest IP moats usually come from the form of protection that is most central to how the company actually makes money. IP becomes most valuable when it is economically important, not merely when it exists on paper. A patent portfolio may look impressive, but if the protected claims are narrow, easy to design around, or unrelated to the core product, the commercial value may be limited. The most valuable IP tends to be central to the main offering, broad enough to matter in the market, legally defensible, and hard for rivals to work around. In other words, the protection has to influence real competitive behavior. Investors should therefore focus less on the number of filings and more on whether the IP meaningfully limits competition. Relevant, enforceable IP is far more important than abundant but weak IP. IP turns into profits through a chain of steps, and weakness at any step can reduce the payoff. First, the company creates something valuable and seeks protection, whether through patents, trademarks, copyright, or secrecy. Second, it actually receives enforceable rights, which may or may not happen in the form management hopes for. Third, it monetizes those rights by selling products, licensing technology, or strengthening customer demand. Finally, it has to enforce the protection when competitors infringe or imitate. Enforcement can be expensive and uncertain, which means smaller firms may struggle even with valid rights. For investors, this is a reminder that strong IP value requires execution as well as legal ownership. IP protection has real limits, and those limits matter a great deal in valuation. Patents and copyrights eventually expire, so legal exclusivity is often temporary. Trade secrets can lose much of their value if they are revealed, reverse-engineered, or leaked through employees or partners. Courts can also narrow, invalidate, or reinterpret claims, reducing the practical strength of protection. And even when the rights are valid, enforcement may be costly enough to weaken the economic benefit. That is why investors should separate legal protection on paper from commercial durability in the real world. Patent life is not the same as market exclusivity, especially in industries with long development cycles. A patent may last around 20 years from filing, but many of those years can be consumed by research, testing, and regulatory approval before commercial sales even begin. In pharmaceuticals, for example, 7 to 10 years may pass before launch. That leaves a much shorter window in which the company enjoys high-profit market exclusivity. So the headline term can be misleading if you do not ask how much selling life remains after the product actually reaches customers. From an investor's perspective, remaining exclusivity is usually far more relevant than nominal patent life. Biotech offers a clear example of how powerful and how temporary IP can be. Imagine a gene therapy company that patents both the treatment and its method of use. During the exclusivity period, it may launch at a very high price, earn exceptional gross margins, and produce enormous revenue because competitors are blocked from offering a close substitute. For several years, the business can look almost monopoly-like, but once exclusivity fades and rival products enter, pricing power often falls quickly, and profitability can drop with it. That pattern is why investors must distinguish between outstanding economics today and durable economics over the full life of the asset. A common investor mistake is to treat strong IP as if it automatically means a strong business. IP may be valuable, but it does not guarantee efficient operations, wise capital allocation, or lasting customer demand. Another mistake is assuming the protection lasts forever when in reality expiry, invalidation, and enforcement risk all matter. Investors also sometimes ignore how dependent the business is on one legal barrier, without other supporting moats, such as scale, distribution, or switching costs. The best analysis combines legal strength with business quality and renewal potential. In other words, ask not just whether the company owns IP, but whether that IP supports a durable economic engine. Section 5. Durable businesses. A durable business is one that can protect profits and competitive position over a long period, often through many different market conditions. The key idea is broader than having one impressive product or one good decade. Truly durable companies preserve and renew their advantages as technology, customer behavior, and competition evolve. They may face disruption, price pressure, or recessions, yet still keep earning strong economics. That usually means the business has more than a single moat and is able to adapt when one source of strength weakens. For investors, durability is what separates a temporary winner from a long-term compounder. It helps to think about durability as a system rather than a single defense. One moat can be valuable, but any one advantage can weaken over time because of technology shifts, new rivals, or changing customer preferences. A more durable business usually has overlapping protections, such as brand, cost advantage, switching costs, scale, distribution, or network effects working together. When those defenses reinforce each other, disruption becomes much harder. A competitor may be able to match one feature, but not the entire system. That is why some businesses remain strong for decades even when parts of their model change along the way. Durable businesses often share a small set of recurring traits. They tend to serve repeated customer needs rather than one-time bursts of demand, which helps revenues stay stable over time. They often have some pricing power, allowing them to raise prices without losing too much business. Sustained high returns on invested capital are another important sign, because they suggest the company has continued to resist competitive pressure. An adaptable core also matters, since even strong businesses must stay relevant as markets change. And finally, durable firms usually operate behind meaningful barriers to entry that keep rivals from easily copying the economics. Durability should never be mistaken for permanence. Even excellent businesses can weaken if technology reduces switching costs, regulation limits market power, or customer preferences move in a new direction. Poor management can also damage an otherwise strong competitive position through bad acquisitions, underinvestment, or strategic mistakes. That is why durability is not a label you assign once and keep forever. It is an ongoing judgment about whether the business is still protecting and renewing its economics. Investors who forget that often pay too much for companies whose best years are already behind them. A practical durability review begins with the company's primary moat. Once you identify the main advantage, look for reinforcing moats that make the system stronger. Then, stress test the business by asking how it would hold up against price cuts, higher costs, a new rival, or changing demand. Historical performance during tough periods can be very informative, especially if returns remain solid during recessions or industry stress. Finally, monitor signs of erosion such as margin pressure, weaker retention, or shrinking market share. The central question is whether the business can still defend attractive returns when conditions become less favorable. Durability should be monitored through evidence, not just narrative. Market share trends can show whether the company is still winning in its category. Gross margin stability helps reveal whether competitors are forcing price concessions or whether the firm still has pricing power. Customer retention is another strong clue, especially in businesses where loyalty or workflow integration should matter. Over time, returns on invested capital help tie the story together by showing whether the economics are still genuinely above average. No single metric is enough, but a consistent pattern across these numbers often tells you whether the moat is strengthening, stable, or eroding. Industrial gas companies are a good example of durability because the products can look commodity-like at first glance. Oxygen, nitrogen, and other gases do not sound like glamorous moat businesses. Yet firms such as Air Liquide and Linde have often earned strong long-term returns on capital. Part of the reason is scale. These businesses require large plants, specialized distribution, and significant upfront investment. Customers also face real switching costs because supply systems are often integrated into their facilities and operations. Long-term contracts further support stable revenue, making the business more durable than the basic product description would suggest. The industrial gas example shows how a durable system can hold together even if a new entrant appears cheaper on paper. Replicating the plants, delivery infrastructure, and customer relationships is expensive and time-consuming. Customers may also be reluctant to switch because downtime or supply disruption can damage their own operations. Existing suppliers are often embedded in mission-critical workflows, which adds both trust and switching costs. These advantages reinforce one another, so a challenger needs to overcome more than just price. That is what durable protection often looks like in practice. Not one dramatic moat, but several solid barriers acting together. Investors often misjudge durability by focusing on the wrong signals. A strong history can create false confidence, but past success does not guarantee future protection if the basis of competition is changing. Weak moats are also sometimes counted as if they were strong ones, especially when a company has a famous brand or a history of growth. Management execution matters because even a good business can be damaged by poor decisions. Industry decline matters too, since a well-run company in a shrinking market may still struggle over time. And high ROI alone can mislead if it reflects a temporary cycle rather than a durable competitive position. One of the best tests for durability is to mentally remove the company's strongest advantage. Start by listing the top 3 sources of protection, then ask what could weaken each of them. After that, imagine the best moat disappearing, perhaps because of regulation, technology, or a strategic mistake. If the remaining advantages still support healthy returns, the business may be more durable than it first appears. If everything collapses once one pillar is removed, then the company may be more fragile than the market assumes. This exercise forces you to look for depth of protection rather than being impressed by a single standout strength.